What if the smallest country in continental America ends up making the biggest monetary decision of the 21st century? While the rest of the world drowns in fiat expansion, stimulus packages, and soft defaults disguised as inflation, El Salvador, a nation with fewer people than New York City, is quietly assembling a weapon of economic sovereignty, a national Bitcoin reserve, not as a gimmick, not for headlines, but as a long-term calculated response to the structural limitations of being small, dollarized, and dependent. In a time when most nations are racing to debase their currencies in a silent war of stealth taxation, El Salvador is doing something radically different. It's building with intention, slowly, methodically, and with eyes fixed on the long game. As of 2025, El Salvador holds over 5,700 Bitcoin. At current prices, around $100,000 per coin, that's roughly $570 million, equivalent to about 4.1% of the country's GDP, a modest figure in absolute terms, but potentially transformational when viewed as a long-term strategic asset. But to frame it only as a number is to miss the point. This is not a story about today's price. It's a story about tomorrow's position. Because when you're accumulating something finite, early accumulation isn't about volume. It's about leverage. To understand why this matters, we have to look backwards before we look ahead. For most of modern history, strong nations anchored their financial systems in hard assets, most notably gold. It wasn't just a symbol of stability. It was the very mechanism by which monetary excess could be constrained and trust in currency could be maintained. Gold was heavy, scarce, and immune to the political winds of the day. But it was also analog, slow to move, difficult to secure, and functionally excluded from the digital world. Bitcoin is everything gold was, and more. It is provably scarce, politically neutral, globally transferable, and natively digital. It doesn't require vaults or middlemen. It operates on code, not trust. For a 21st century economy, it is the logical successor to physical reserves. And El Salvador seems to understand this before almost anyone else. They are not trying to disrupt macroeconomic theory. They're simply following a principle that history has always rewarded: hold what others cannot print. Most governments diversify their reserves: gold, dollars, bonds, SDRs, a bit of everything, just in case. But what El Salvador is doing with Bitcoin isn't diversification. It's something much more profound. It's the construction of a new monetary pillar, a sovereign strategic reserve, built outside the traditional financial system. And when you look closely, the logic is undeniable. Because if Bitcoin continues to appreciate over the coming decades, as adoption increases, supply tightens, and trust in fiat wanes, then the Salvadoran balance sheet could be structurally transformed. As Bitcoin appreciates over time, the value of El Salvador's reserve grows relative to GDP. At a 300,000 BTC price point, the country's holdings would be worth over $1.71 billion. Roughly 12.2% of GDP. At $1 million per coin, that figure would jump to $5.7 billion, more than 40% of GDP. This isn't fantasy, it's math. And unlike GDP, which is notoriously hard to grow sustainably, a Bitcoin reserve compounds without bureaucracy. Small countries often face brutal constraints. They borrow in someone else's currency. They depend on someone else's central bank. And when crises hit, their only options are external bailouts, which always come with strings. But a credible Bitcoin reserve breaks this dependency cycle. It means fewer negotiations with the IMF. It means less exposure to dollar volatility. It means access to capital markets from a position of strength, not weakness. In a future financial crisis, Bitcoin becomes a source of instant global liquidity. It doesn't require approval. It can't be frozen. And it moves at the speed of code. For a country like El Salvador, that kind of optionality isn't theoretical. It's existential. Critics often say El Salvador gave up its monetary sovereignty when it dollarized in 2001. And on one level, that's true. It no longer controls its own currency. Interest rates and inflation are imported directly from Washington. But what if Bitcoin could reintroduce monetary leverage without abandoning dollarization? That's what El Salvador is building. Not a replacement for the dollar, but a counterweight. A digital, decentralized asset that doesn't care what the Fed does. That isn't printed to fund wars. That can't be inflated away. In a sense, Bitcoin acts as a hedge against imported monetary policy, a second layer of protection, a reserve asset that strengthens precisely when fiat systems weaken. It's not about escaping the dollar, it's about insulating from its consequences. Of course, most critics focus on the obvious. Bitcoin is volatile. It moves, sometimes violently. How can a country build reserves on something that swings 5% in a day? But volatility isn't the enemy. For long-term accumulators, it's a feature, not a bug. El Salvador isn't trading Bitcoin, it's buying 1 BTC per day, slowly, quietly, consistently. That's dollar cost averaging at a sovereign level, a methodical way to reduce entry risk and flatten volatility exposure over time. When you zoom out to a 10-year horizon, day-to-day swings become irrelevant. What matters is direction, and Bitcoin, with its halving cycles, adoption curves, and capped supply, is structurally designed to rise as fiat credibility declines. This isn't speculation, it's asymmetric risk management. Let's imagine a near-future scenario. It's 2035. Bitcoin is widely held by sovereigns. Prices are no longer speculative. El Salvador's reserve, once dismissed as a bet, is now worth billions. What does that unlock? The country can issue Bitcoin-backed sovereign bonds at better rates. It can negotiate with creditors from a position of strength. It can collateralize development projects without relying on foreign governments. It can lower external borrowing needs altogether. This is what Bitcoin does when held strategically. It becomes a macroeconomic tool. Just like oil exports fund Middle Eastern surpluses, Bitcoin appreciation could fund Salvadoran infrastructure, education, healthcare, even tax relief. In effect, Bitcoin becomes the resource El Salvador never had. But instead of extracting it from the ground, it accumulates it from the future. There's a reason global institutions are uneasy with El Salvador's Bitcoin pivot, because if it works, the model is replicable. There are dozens of nations with high inflation, weak currencies, and external debt burdens. Nations stuck in a cycle of dependency. For them, Bitcoin isn't ideological, it's strategic. A mobile, incorruptible store of value, available to anyone with an internet connection. No mining required, no military needed, just discipline, time, and vision. El Salvador is showing the way, and quietly other governments are watching. Not from curiosity, but from necessity. Let's be clear, El Salvador's Bitcoin strategy is not about rebellion. It's not about rejecting the West. It's not even about being first. It's about financial architecture. It's about saying, if we can't print and we can't borrow endlessly, and we're vulnerable to shocks we don't cause, then we need an asset that's outside the game board. That asset is Bitcoin. And when historians look back on this era of monetary fragmentation, they may see El Salvador not as a renegade, but as an early architect of a post-fiat sovereign strategy. If this works, if Bitcoin appreciates, if other nations follow, if the monetary order continues to fray, then El Salvador's reserve will no longer be an anomaly. It will be a benchmark, a new category of sovereign asset, a digital foundation for financial credibility, a quiet revolution that started with a tweet and became a balance sheet strategy. And the question for other nations won't be, why did they do it? It will be, why didn't we? El Salvador isn't hiding. Their Bitcoin purchases are public, their wallets are transparent, their strategy is clear, and yet much of the world still frames it as a gamble. But building something new always looks risky, until it works. And if it does, then this moment, this slow, methodical accumulation, may turn out to be one of the most important financial stories of our time. Not because it made one country rich, but because it showed the world that sovereignty can still be earned, one sat at a time.